You know how the stock market can feel like it's speaking its own secret language? Well, today we're going to crack that code. We are going to break down stocks and this really powerful tool called options, and we're going to do it all using one of the biggest names out there right now, Nvidia.
So, here's what we've got on tap. We're going to start with the absolute basics, what it means to own a stock. Then we'll jump into the world of options, looking at it from both sides of the coin, buying and selling. And then at the end, we'll tie it all together.
Okay, let's dive right in. First things first, before we get to any of the more complex stuff, we have to nail down the foundation. I mean, what does it really mean to own a stock?
You know, it's actually way simpler than most people think. When you buy just one share of a company like Nvidia, you're literally buying a tiny, tiny fraction of that company. You become a part owner. Simple as that.
I love this analogy. Think of the whole company, Nvidia, as a giant pizza. Buying one share? That's you getting one slice. Now, if that pizza place gets amazing reviews and everyone wants a piece, well, your slice just became a whole lot more valuable.
So the name of the game at its most basic level is incredibly simple. Buy low, sell high. You buy a share of Nvidia for, say, $500, it goes up to $600, you sell. Boom. That $100 difference, that's your profit. That's the core idea.
All right, so that's stocks in a nutshell, owning a piece of the company. But what if you don't actually want to own the pizza slice? What if you just want to make a bet on whether it's going to get more popular or less popular? Well, that's where we get into a whole new set of tools called stock options. And this is the absolute key difference you need to get. An option is not ownership. It's a contract, and it's temporary. It gives you the right to do something, buy or sell, at a price you lock in today. But here's the kicker. You don't have to. It's a right, not an obligation, and it all has an expiration date.
So these option contracts basically come in two flavors, calls and puts. A call option gives you the right to buy. You do this if you're bullish, if you think the stock is going to the moon. A put option gives you the right to sell. This is for when you're bearish, when you think the price is going to drop.
Okay, let's use another analogy for a call option. Imagine it's like putting a small deposit down on a concert ticket for a new band. You lock in today's price. Now, if that band suddenly becomes the biggest thing on the planet and ticket prices go through the roof, you're golden. You still get to buy your ticket at that original cheap price you locked in. And a put option? Well, that's kind of like insurance for your phone. You pay a small fee every month, right? If your phone is fine, you're out that small fee. But if you drop it and shatter the screen, or in our case, if the stock price totally crashes, that insurance policy kicks in and guarantees you can sell it for a certain price. It's protection.
So we've got calls for going up, puts for going down, but what does this actually look like in practice when you're the one buying one of these things? Let's get into the numbers.
Okay, so check this out. Let's say you're buying a call on Nvidia. You pay $10 for the right to buy the stock at $550. That $10 is called the premium. Now here's the important part. For you to actually make money, the stock doesn't just have to get above $550. It has to get above $550 plus the $10 you paid for the contract. So your real break-even point is $560.
But, and this is where it gets crazy, if Nvidia goes all the way up to $600, well, your little $10 investment just made you a $40 profit. Do the math on that. That is a 400% return. That is the power of leverage. You're using a small amount of cash to control a much bigger asset. It's what makes buying options so incredibly powerful. And also, yeah, incredibly risky.
And it's the exact same idea, just flipped upside down for a put. Here, you're betting the stock's going to fall. You pay your $10 premium for the right to sell at $450. So for you to profit, the price has to drop below $450 and cover your $10 cost. Your break-even is $440. But if that stock takes a nosedive down to $400, cha-ching, you're in the money.
So let's sum it up for the buyer. The pro is huge, right? Massive reward potential. And your risk is capped. You can only lose the premium you paid. That's it. But the con is a big one. You have a very high chance of losing that entire premium. Time is constantly ticking against you, and if you're wrong on the timing or the direction, that money is just gone.
Okay, but think about it. For every single person buying one of these options, there has to be someone on the other side selling it to them. So let's flip the script. Why on earth would someone want to sell these things?
Well, the seller's mindset is totally different. They're not swinging for the fences. They're not looking for that 400% home run. Nope. Their game is all about consistency and playing the probabilities. Their main goal? Income. They collect that premium, that $10 from our example, and they get to keep it. Think of it like collecting rent. Their other goals are more strategic. They can use options to get paid while they wait to buy a stock they want, but at a lower price. Or they can use them to set a price where they'd be happy to sell shares they already own. And this leads to the two most common selling strategies. If you already own the stock, you can sell a covered call. You're essentially agreeing to sell your shares at a certain price if they go up. On the flip side, if you want to buy the stock, you can sell a cash-secured put. You're getting paid to agree to buy the shares if the price drops to a level you like.
So you see the trade-off for the seller, right? They get guaranteed money in their pocket, right now. The premium is theirs to keep. But in exchange for that cash, they take on an obligation. They might have to sell their winning stock and miss out on even bigger gains, or they might be forced to buy a stock as its price is falling.
Whew, okay. We've gone from just owning a stock all the way to buying and selling these complex contracts. So let's take a step back and put all these tools on the table to see how they fit together.
And this really lays it all out perfectly. Each of these strategies serves a totally different purpose. Buying the stock, that's your classic long-term growth play. Buying calls or puts, that's pure speculation with high leverage. And selling options, that's all about generating income or being strategic about how you enter or exit your stock positions. Completely different goals for each tool.
You know, if I had to leave you with one final analogy, it's this one. Owning the stock, owning Nvidia, is like owning the goose that lays the golden eggs. You own the asset itself. Options, they're not the goose. They are simply contracts about where the next golden egg might land. You're just betting on the eggs, not owning the goose.
And that really brings us to the most important question of all. Now that you understand the difference between owning the goose and just betting on the eggs, the question you should be asking yourself isn't, which one is the best? No, the real question is, which one of these tools actually fits what I'm trying to accomplish?